Tax planning. If you are a business owner or you are an individual taxpayer where you have an income and you're paying tax, this one is for you. We're going to be talking about some simple strategies on tax planning, going to give you some understanding of what tax planning is, and I want you to walk away after watching today's video to understand why you should do it, why tax planning matters. If we're not growing, you're not growing. If you guys are new to this channel and you've only just met me, my name's Rigney. I am an accountant. I've been an accountant since I was 19 years old, and I've been in practice for the last 10 years. And what I really love is helping clients. I love helping business owners become profitable. I love basically pointing out to them or showing them the way of how they can be more profitable and basically have more money to enjoy the fun things in life. Because remember, business needs to serve you. You shouldn't be serving the business. All right, so today is all about tax planning. What the hell is tax planning? Why do we do tax planning? In May and June, we start looking at doing tax planning. And effectively what tax planning is, because the tax year starts in July and we've got to May, we've got like a solid amount of data to understand how much your business has earned. If I had to nut down what tax planning is, it's really, and I got like a really boring definition here, which I'm going to read for you actually, because I've got it written down here in front of me. Tax planning, the definition is proactive structuring of your financial affairs to legally reduce your tax liability. Let me just put that in plain English. Basically, it's having a look at how you perform this year, how much money have you got, how much tax is the ATO going to ask for when it comes to your tax bill in a few months' time, and let's find out a way that we can legally reduce it. Simple, right? It's not tax avoidance, it's not fancy tax schemes, it's nothing crazy, we're not doing anything dodgy or illegal. It's about finding effective strategies to help you reduce your tax. The reality might be that maybe your business has just gone so well this year and I just want to look at a few things that I can do to reduce the income. Maybe it's as simple as bringing forward some expenses so that you can reduce your tax liability for this year when maybe next year is not going to be as great. Maybe personally you've had a huge amount of income come in that's unusual. Maybe it's a capital gain. It's about looking at what strategy you can put in place that is legal, that is ATO approved, that can help you pay less tax. Simple, right? So I've been doing tax planning for years and I've had all sorts of people come in, from people who have had capital gains. What can I do to reduce the tax I'm paying on the risk I took on investing into a property or some shares, and now the ATO wants some of that profit? Or maybe you're a business owner where you've had a really good year, like I said before. It's about putting strategies in place. And what we do as accountants is that we sit down together with our clients and we have a look at what actually has happened. And the next thing we do is we predict based on the current data, and then also understanding what's going to happen in maybe the end of May or June. And we prorata the income out. So we've got an idea of what the entire income for the whole year is going to be. And once we do that, we just work out what the tax bill is going to be. From there, we think about what strategies we can put in place to then go and reduce that income. And that could be something as simple as prepaying some interest on my investment loan. Or it could be we need some new equipment and we want to make use of some of the tax incentives that are out there, like the instant asset write-off, where if you buy something under $20,000 and you're a small business and you're eligible, you can write that piece of equipment off all in one go. So it's about looking at these things. It's not about spending extra money for the sake of spending extra money to save a few cents of every dollar to give to the ATO. It's about looking at some practical, real solutions that help your business grow, but then also help reduce the tax you've got to pay. So that's tax planning, and that's really why it matters. Let's get on to some really simple strategies that you can put in place. One thing that I would say is really important as well is anything that you want to do tax planning to save any tax on the income you've gotten this year, the strategies need to be put in place before the end of June. So that means that if you were buying a new piece of equipment and you wanted to get that 20 grand utilizing that automatic instant asset write-off, you would have to be buying that asset before the end of June and it would have to be installed in that scenario. You can't be going in July and saying, I want to do that now. It's too late. And that's why we look at it in May and June, is because we want to have enough time so that you as the business owners or the income taxpayer to go and put those strategies in place. One thought before we move on, I just really wanted to share with you the famous quote from Kerry Packer, and I don't have it here for word, but basically what he was saying was, hey, you know what? There was an inquiry on basically how much tax Kerry Packer was paying. If you don't know who Kerry Packer is, he was this multi-million-dollar business owner. He owned Channel 9 at one stage, famous for so many business activities in this country. And in this inquiry, he was being quizzed about his tax deductions that were not contrary or in the spirit of the tax laws of Australia. And his quote was basically, you know what, you guys as a government, you're not spending it wisely, so I don't know why I'm going to donate any extra or any more than I have to. And he said, anyone here in this country as Australia, if you're a taxpayer, if you're paying any more, then you should have your head read. So I think it's a great famous quote, and it's so true, right? This is not a podcast about getting into politics, whether left or right or anything like that. Yes, you've got to pay the fair amount of tax, but it's also about only paying what is fair for you. And if you can reduce that tax liability, you 100% should. So let's just talk about some common tax strategies that we put in place. Now, what I'm going to talk about today doesn't mean that, hey, you don't go and see your accountant. You should still see your accountant because everyone's circumstances is different, and it's really a good investment in your time and your business to actually see your accountant regularly, but especially book a time with your accountant, sit down with him or her and talk about what's happening in the business. So let's start with an individual taxpayer, right? You always want to be maximising your deductions. So before the end of the financial year, it's making sure that you get all your paperwork all in place and having a look at what deductions you've got and how much you've spent. And on our website, for example, we have some checklists of what you can claim and can't claim and what you should look at. But depending on your circumstances, it might be that it's time for a new car and then I get some more depreciation for maybe this year and future years, or it could be looking at equipment. Maybe you have to buy your own IT equipment or your own phone, and it's looking at buying that and then claiming that in your return. If your employer allows it, you might go, hey, I need that, but what I can do, and this is a great strategy as well, is say, can I salary sacrifice that with my employer? And if it's 100% business use, your employer can basically claim it. So the way they would do it is, when we talk about salary sacrifice, you go and buy a piece of equipment, say for example a laptop or a phone, and because it's work related, what will happen is your employer will refund you for that. So instead of you getting income in that week, right, the income you put through in payroll is reduced, and it's like they're reimbursing you for something that they wouldn't ordinarily buy for you, but they're reimbursing you for some equipment that they're going to go claim, but you're getting that tax deduction there and then. It might be that, say for example, as I said earlier, you've had an unusual year where your income is really high because something out of the ordinary, like a capital gain. So looking at maybe super contributions, how can you maximise the unused concessional contributions above and beyond maybe what your employer pays in super guarantee? Can you that additional amount up to your cap? And for this year, it is $30,000. So can you put that extra money in there? And then what's the benefit of you putting that in there? So remember that you're going to get the tax deduction on your name and your personal return, but then also when the super goes into your super fund, you'll get taxed 15% there. But you won't personally be taxed, but your super fund will. There's a few things to consider as well, and this is why it's really important to sit down with your accountant, but you might want to look at, am I impacted by Division 293, which is essentially if you earn more than $250,000, that when your super fund, any contributions it's received, gets taxed at 30%. So 15% usual rate, plus another 15% called the Div 293 tax. So you want to look at all these different things and think about, if I do this, do that, what's going to happen? Depending on what your super balance is, you might also be able to look at previous years of unused super contribution concessional caps you haven't used up to a certain balance and make that as a whole contribution. But what I would suggest is that have a look with your accountant on how much you have put in super, your employer, and then even maybe if you have a financial planner, because it can constitute financial planning advice, and accountants cannot give financial planning advice unless they're licensed. Speak to your financial planner and work the accountant and your financial planner to work out how you can put extra money into your super fund and get a tax deduction and get a benefit there and then for helping towards your retirement. Some other great things you can do as well, maybe if you've got an investment property, it's looking at prepaying some interest on the loan you've got. It could be that maybe you feel like you want to put some donations in, maybe it's putting the donations in that you're going to contribute for this year all in by June. It could be as well that if your income has gone up, have you got private health insurance? And that's another good one as well. If your income is for a single, I think it's $95,000, or for a couple about $180,000. But basically there's those thresholds around there for the Medicare levy surcharge, which basically says that if you don't have private health insurance and your income is in that high bracket, single for a couple, a family, it's looking at the combined incomes. But it's looking at what the combined income is and then seeing if we don't have private health insurance, we're going to pay an extra amount of tax called the Medicare levy surcharge. So the only way to avoid that, if your income is over the threshold for the surcharge, is by having private health insurance. The way it is calculated is based on the number of days you've got the health insurance policy. So you can imagine that if you did fall into that income level of the surcharge and you took out the insurance today in May, you won't be paying for the Medicare levy surcharge for May and June. But for the previous, I guess for the start of the year, for any income you've earned, say the first 300 days, will be captured by the Medicare levy surcharge. So that's more of a future planning thing as well. And thinking about, hey, my income's got to a certain threshold, now I really need to think about getting private health insurance. And I think it's really important to probably have private health insurance anyway. And I got that tip from one of my clients who's a doctor a very long time ago. So common tax planning strategies for business owners. First of all, we want to have a look at, like I said earlier in the video, we want to have a look at where your income is and then how much your income is, get an idea of what your income level's at. The next thing we want to do is we want to have a look at what strategies we can put in place. And it's really about going through, looking at the profit and loss, and then looking at the balance sheet and looking kind of what assets there are, and then having a discussion with the client or the business owner and thinking about what's currently happening in your business. And if I talk about my gym client, when we sit down and talk, we talk about, hey, there's a whole lot of Pilates machines that she has, and 4 of the 10 beds are broken. So they're no good anymore. Let's get rid of them. We'll chuck them out. But I'll get the 4 beds now so that I can make that an automatic tax write-off, because each bed is under $20,000, so happy days, right? We can take advantage of that instant tax write-off. But other things that we might look at as well, and some other great strategies could be, for example, looking at your structure of your business. So if you're currently a sole trader, it might be, hey, what are the benefits of you going from a sole trader to a company? And look at that now so that when you come to 1 July, you can start fresh in that company from 1 July. Because the reality is, if you go from sole trader to company midway through the year, what's going to happen is you're going to have 2 businesses. You're going to have a sole trader business and you're going to have a company. But this way, if we do it in July, it's a nice fresh date to start on, but then also one business closes, the sole trader business closes in June, and then the new one starts in July. Sitting down with your accountant, it's really important to also look at the structure and think about the current structure you did have, you've now outgrown it, and it's a good growth strategy to be anything from protecting yourself from possible liabilities in the future, but then also there could be future income benefits by implementing a change from sole trader to a company, and also thinking about other things like, should I set up a trust to hold the shares in my company? And having a look at that sort of stuff as your business grows and you implement it whilst you're small, it's an investment in the future to help reduce any future tax liability, to be in a better position to be protected. Because the last thing you need as a sole trader is that whilst you might have a really good insurance policy, if that insurance policy doesn't cover you for any damage that may occur, you then become personally liable. And the last thing we need for anyone that's in business is, you guys have taken a whole lot of risk so that you can earn some money. And whilst some things go bad, we want to reduce that risk of you going in business by making sure that if you operate a company and operate within the means of what you should do as a director when you run it, that you are protected so you don't lose your family home. If, say, for example, something really bad happened, as an example, if you were a sole trader. So having a look at that, and then once again as well, another great strategy for business owners is looking at super, particularly with your employees. Now, the reality is with super guarantee, you have to pay that. You're supposed to pay that every quarter. But what makes it tax deductible is when the super is paid. So it's looking at, even though we might expense in your business the super for this financial year, we're only going to make a tax deduction based on the super you've paid. So there's no reason why that if you want to, of your employees or yourself, and if you're running a company, remember, when you pay yourself, you're an employee of the company as well. There's no reason for you, every time you do a pay run, that you pay the super there and then, or you can pay it monthly. You don't have to wait till the end of June to pay your employees super on their wages, right? The super guarantee. So what you can do is pay it early, because you're going to have to pay it anyway. So if you're paying it in July, you might as well pay it in June and get the tax deduction now. The other thing that's really important as well when it comes to tax planning is understanding that any super that is paid late is not tax deductible. And these simple little strategies, that's something that you want to apply throughout the year, always making sure that you're paying every employee, whether they're a family member, it's you, or non-related family members, any employee, that you always pay that super on time, because that is tax deductible. But when the super is not paid on time, it is not tax deductible, and it means that you're not going to get that tax deduction. You might also want to look at, before the end of the financial year, maybe there's staff who have performed really well this year and you want to give them a bonus. If you pay that bonus in June, therefore it's tax deductible in this financial year. So there's some little things that you can do, whether you're an individual or a business owner, that you can apply to then save some tax. But it's really, like I said, it's about looking at where you're at now, what is the income, what are things that we need to do or we can do to then save some tax dollars. And it's about it also making sure whatever money you spend, it's because it has to be spent. There's always an investment or a return back on the money that you spend. So there's no point, for example, if I look at my gym client, going out and buying a whole lot of new equipment or beds, whatever it might be. If you don't need them, don't go and spend the money. You're better off giving the ATO, if you're a small business, 25 cents in every dollar of the corporate tax rate. There are some really basic mistakes sometimes as well, business owners that we commonly see, or even especially individuals. It's first of all understanding what you can claim, what you can't claim. So you really want to get a good understanding about that. It's also making sure that in your zero file that everything's reconciled. Now, if, say for example, you use your own personal bank account sometimes to pay for expenses for the business, and that's not connected to Xero and you don't tell your accountant, we don't know. So you've got to make sure that you let us know about that. But it's also some simple stuff as well, tracking that all your depreciation's claimed. And I've seen this just previously with another accountant that I've taken some work over for a client, where the previous year the accountant didn't claim all the allowable depreciation and then also didn't claim all the interest on the finance of the equipment that was bought in the business. So sometimes as well, there are accountants out there, unfortunately, that don't claim everything that they should. The other thing as well is that, remember, we're not mind readers. So if you've made extra expenses that are outside of your Xero file, your MYOB file, whatever you're using, you got to let us as accountants know as well. So if I look at my gym client, and I think she's a great example of great tax planning, she always reaches out to me early May and says, let's book in a date to talk about tax planning. And this client, she's amazing. She's got 3 different businesses and she's got quite a bit of income to think about how she can save, but then also what she can do to invest in the business going forward. And a few things that we've done with her in the past is looking at what the income is and seeing how can we maybe pay some of that income to her husband, right, who works in the business, and spreading, because she's on the highest tax bracket, and then spreading that income into her partner. We've looked at restructuring her company and changing their shareholding so that shareholding is in a trust, and making sure that yes, we pay market salaries for what she does, but then any other income goes into the trust, and then we can distribute it to lower income tax brackets, or we can invest that money into bucket companies. But we've looked at the structure and then applied what is legal to then help build her personal financial wealth and reduce her taxable income. And then we've looked at other things over the years as well, where the gym has expanded and it's got bigger, and because there's more people in there and because the gym is growing, we've looked at buying more equipment, because the equipment that she had wasn't good enough for the new type of clientele she had in the business. So when she started, she bought a lot of second-hand equipment just to get it going, and that's a really great example of forced frugality. She wanted to create a business and she was really sensible the way she spent money and didn't overcapitalize. But when the business could afford it and the profits were there, she looked at getting new equipment, because the equipment she had was broken. And that was everything from beds for Pilates to weight machines, and even just wear and tear of equipment. It's about understanding the story, understanding what's currently happening in the business. And I remember of last year, she said that, oh, look, you know what, there's a lot of damage because there's some storms and whatever, and the insurance paid for some of it, but things aren't matching, and so I need to do some repairs and maintenance. So instead of doing it in July and August, she did it in June. And she made sure she got it done in June, because then it was tax deductible in June as opposed to being tax deductible in July. And then she got the tax deduction there and then saved that money there and then. So that's a really good example. But another great example, just on a personal nature, was one of my clients who had sold a rental property that he had held since 1990, and the capital gain, as you would understand, was absolutely huge. 35 years holding this property meant that there was a huge capital gain. What was really smart about this client is before he sold it, he came to me and said, I'm thinking about selling it. And the way we saved taxing was all about timing. So I said, hey, what I want you to do is in that year, like it was around about now, he was thinking about selling it. And I said, can you hold off until selling it in July? Yeah, I can do that. Great. And the reason that worked really was because when he sold it in July, he had then the whole of that current financial year plus then another 11 months before he had to pay the tax. And it gave us a lot of time to think about, oh, what other things we can do to reduce his tax liability. And that was some simple things like even just paying super, right? But having that phone call with me very quickly saying, hey, look, you want to sell it, can you hold out for a month, meant that, yes, the tax liability was still the same. And yes, we did some things to reduce the tax liability, but it also meant that that amount of tax could sit in his offset account to reduce interest on his loans. And then when it came payable, effectively, he sold something in July and didn't pay the tax on that for 20 months later. So a lot of this stuff when it comes to tax planning, it's all about understanding what's happening. It's all about strategy and then planning for those strategies and putting that in place. So there's a few things I just want to talk about when it talks about legal and ethical, just about getting your paperwork right. Really important that you keep all your records and you can substantiate any tax deductions that you make. That's the first thing. The next thing you got to do is you really want to work with a qualified accountant, and if you've got a financial planner, involve them in the tax planning. Especially, I want to make special mention that if you are contributing any super to your super fund and you want to make that a concessional contribution, i.e. tax deductible in your tax return, it's really important that you fill in the forms with your super fund to let them know that you want to make it a tax deduction. We call it a notice of intent form, and you need to get that completed so that then the accountant needs that letter first before they can go and claim it. So you can't claim it and then go and ask for that notice of intent form, because otherwise the ATO will disallow your tax deduction for your super. So really important that you notify your super fund that you want to make it a tax deductible contribution, so i.e. a concessional contribution. So that is pretty much tax planning, guys. That's everything I need to really talk to you about. It's really important to get onto tax planning now. We're in May, or if you're watching this and it's June, it's really important to put the strategies in place now and know what's going on. So the action steps for you guys as business owners or individuals is to make a planning session with your accountant, call someone like myself, phone call, and actually book in and do a review with your accountant. Invest in the time to sit down with your accountant and then go through with them a checklist of what you can and cannot do, and then put the strategies in place. But it's really important that you do this before the end of June. Well, guys, I hope you enjoyed this week's video. Look, there is a stack of videos that we have on our YouTube channel. Have a look at them. We've talked about other things you can do about growing your business. And if you guys love what we're talking about, please give us a thumbs up and share it with your friends and family. My name is Nathan Rigney. I'm the Profit Generator, and thank you for watching.